Hi, we're going to walk through problem 16-1B, Production Cost Flow and Measurement. Dream Toys Company manufactures video game consoles and accounts for product costs using process costing. The company uses a single processing department. The following information is available regarding its June inventories. So it gives us the different inventory accounts, raw materials, work in process, and finished goods, and the beginning inventory and ending inventory for each account. So you see I've set up the T accounts and I've already populated the beginning and ending inventories from this table. The following additional information describes the company's production activities for June. So it gives us raw material purchases, factory payroll cost, other overhead costs, materials used, both direct and indirect, labor used, direct and indirect. Overhead rate is going to be calculated as a percent of direct labor, and then it tells us what we're going to sell the product for. So required, compute the cost of products transferred from production to finished goods, and then cost of goods sold. I'm going to utilize the T accounts to walk through, and then also in the solution that's below, it gives it to you in a table format. Same numbers. We're also to prepare journal entries to record the following production activities during June: raw material purchases, direct materials usage, indirect materials usage, direct labor costs, indirect labor costs, payment of factory payroll, and other overhead costs. Overhead applied. So all of that up until overhead applied is going to be just information from our table for the journal entries. When we get to overhead applied, we have to do the calculation. You have to calculate goods transferred from production to finished goods, which is the cost of goods manufactured, and record the sale of the finished goods, both the sales amount, the sales journal entry, and the cost journal entry, which would be the cost of goods sold. So we're going to work through this information using the T accounts to calculate the amounts. Again, you can do that in the table format that's listed below, and then it has all of our journal entries that we're going to be calculating the amounts for. Okay, so again, I've put in the beginning inventory and ending inventory. So for purchases, we know these are raw materials. So we may have purchases from materials, and then we might have some that are actually used in direct materials to work in process, or as indirect materials to overhead. So we have raw material purchases of $200,000. And then we can calculate beginning inventory plus purchases minus ending inventory will give us the inventory, the materials inventory that's been used. But it also actually gives it to us in this actual table as well. So we have materials used, direct, 120,000. So we know for work in process we have three cost components: direct materials, direct labor, and overhead. So the first one we're going to do is the direct materials of 120,000. Then we have some direct labor of 350,000. And we have some overhead costs. So we're going to take our direct labor times 75%. So those are going to be the three cost components. To calculate the amount of cost of goods manufactured, we're going to take beginning inventory plus direct materials plus direct labor plus overhead. Those are all debits to the work in process inventory account. We're going to subtract ending inventory, and that's going to give us the cost of goods manufactured amount. So it's leaving work in process. We've now finished the product. So it's going to be a credit to work in process, decreasing that account, and it's going to be a debit to the finished goods inventory. It's going to be an increase to finished goods. Then we have it sitting there available for sale. When we sell the product, it leaves finished goods, it leaves our balance sheet, leaves our facility, and it's going to go over to cost of goods sold, which is on the income statement. And it would go out the door to our customer. To calculate the amount, we're going to take the beginning inventory plus cost of goods manufactured minus ending inventory. and it gives us cost of goods sold of $600,500. That's going to be a debit to cost of goods sold. It's an expense, and it's going to be a credit to decrease our inventory account finished goods. So that's how you can utilize the T accounts to calculate the amounts. To look at our actual journal entries, most of them are kind of simple, taking the amounts from the table. But on A, we're going to record the raw material purchases. So we see that's going to be $200,000. We're going to debit raw materials inventory, and it said it was on credit, so we're going to credit accounts payable. Then we have some direct materials that are used. The amount that's direct is going to be debited to work in process inventory. It's coming out of raw materials inventory, so that's where we're going to record the credit. For the indirect materials, we debit factory overhead and we credit raw materials inventory. To record our labor, we're going to debit work in process inventory for direct labor. We're going to credit factory payroll payable. Our indirect labor is going to be debited to factory overhead and credited to factory payroll payable. The amount that we actually pay in cash for our payroll given to us in the table, we're going to debit factory payroll payable and we're going to credit cash. We also had some other inventory overhead costs right here, other overhead costs, and it tells us to credit other accounts. So we're going to debit factory overhead. We're going to credit other accounts. In reality, some of this could be prepaid rent, prepaid insurance. It could be accumulated depreciation. It could be just a number of things. But just to keep the problem simple, it just said to use other accounts. Then we're going to calculate the amount of overhead to be applied to our work in process inventory account. It gives us the formula 75% of direct labor costs. So we're going to take our direct labor of $350,000 times 75% gives us $262,500. So we debit work in process inventory and we credit factory overhead. Then we calculate the amount that actually is completed, our cost of goods manufactured. That journal entry is to debit finished goods inventory. That's where it's going. That's the account that's increasing. And the one that's decreasing, or where it's coming from, is work in process inventory. When we sell the product, we have a sales journal entry, we have a cost journal entry. What we sell it for, we're going to credit sales, and in this case it was on account, so we're going to debit accounts receivable. The amount of the cost, we're going to debit cost of goods sold, we're going to credit finished goods inventory. So that's the end of this problem.